Okay, everybody, I had to start today's class just a little earlier because of extenuating circumstances. But on the other hand, we are prepared, um, to go move forward. Next week's meeting will be on Thursday. I had some feedback that people wanted to have the meeting a little earlier, so I'm going to try that. I'm going to make it Thursday at 11 a.m. So that'll be Thursday the 6th at 11 a.m. Okay, so be aware of it. I will send out the hold on. I will definitely send out the link in a little while if you want to join me. If not, you're going to have the recording, so you'll see everything on the recording, and that should help you in terms of catching up or being prepared for the class. The other feedback I received was that there's no feedback on the McGraw-Hill. When McGraw-Hill, the idea behind doing the McGraw-Hill is that the things that you get wrong, you repeat. That's sort of your feedback. It's very hard for us to go in the system and individually feedback every student because the system is doing that. That's why we've employed the system. As it is, it kind of works on an AI basis. So the bottom line is you know what you're getting wrong because they're repeating those questions to you. However, so just to give you an example, let's take a look. Let's take a look together. So I want to be clear, we always want to keep and it's not a, it's a small, it's just, very small feedback because I think, the majority of you are okay with it. It's from what I could see, but let's just take a look anyway. So let's go to module 4. Sorry, module 3, which is where we are today. And let's open up. Now you got the video lecture, so that's good news number 1. Let's look at the assignment. So on the assignment, I'm going to preview it for you. So we got one student actually working on it right now. Let's take a look. So when you open this up, after you've watched the video, right, you're going to see this algorithmic question, which is going to give you an income statement. And then they're going to say perform a horizontal analysis, which I'll get into, and perform a vertical analysis. And basically, that's the answer, right? So you're going to do that. If you get anything that isn't working out, right, hopefully, you are you'll see it and you'll continue to work on it until you get it correct, right? So in this particular case, that's going to give you what you need to know. You can also use a hint. So hopefully that's going to be enough feedback. Okay, and you can watch the video again. So I'm hoping that helps. I mean, that's how McGraw-Hill designed it. We talked to these people. We're hoping that's how it'll work out for you. And the second one, it's sort of the same thing. Okay. And you can also use a hint to report a content issue. Now, here's the bottom line. If you still feel, then the third one would be similar. You have to give us interest earned. You have to back in. Basically, this is going to require a knowledge of how the financial statements work, right? You have to do turnover. It's basically going to be ratio turnovers and questions like that. If you get to a point, and then going back, let's just go back for a minute. If going back to this, you still feel, hey, I still don't get it, and that's fair, and more than fair. And then you go to the video lecture. Let's take a look at the video lecture. Let's watch it together.
All right, in this video, I want to introduce the idea of financial statement analysis. And we've spent a lot of time learning how to put financial statements together, how to make income statements and balance sheets and cash flow statements. But we haven't really talked about how users analyze that information, or how they use financial statements to actually make decisions. So that's what we're going to do in this video. And we're going to focus on 3 different financial statement analysis methods. Okay, we got horizontal analysis, we got vertical analysis, and we got ratio analysis. So we're going to kind of introduce each of these briefly in this video. The first one is horizontal analysis. And in horizontal analysis, we're just going to compare across accounting periods.
The one thing that should be happening here is that whatever is given to you in terms of your assignments, you're also going to see it here in the analysis and when you watch the video. So between the video and your assignments, if it's still not clear, well, then what you have to do is contact me. And that's when I can offer you feedback. That's my best way of you feedback. What I'm seeing when I look at the grades is many of you are scoring extremely high. So if you're scoring high, and again, this was like one comment, but I like to address every comment. It was one comment, but I like to address every comment. One comment was the live classes were not early enough, so I'm going to make that Thursday. The second comment was I'd like a little more feedback. Well, I'm trying to help you with that. Okay, so let's watch the rest of this. But if there's another person out there who feels the same way, well, there's your feed. There's a full explanation plus what I'm going to give you now. So hopefully the combination of both is a help. Now I know it's not always easy to make the live classes at a certain time, so I'm going to try to I try to do the best I can, but I do give you the videos, and if you have questions you can ask. So in effect it becomes interactive. And by the way, this week's code word, because I know I've been bad with that, is feedback. This week's code word is feedback.
Period. So we're going to do things like compare sales. So we'll compare sales in year 4 to sales in year 3. And we can do it in absolute terms, which means we can compare, well, in year 3 we had 800,000 in sales, and in year 4 we now have 900,000 in sales. So we've had a $100,000 increase. That would be the absolute increase. Or we can look at the percentage increase. And you see here I have the percentage difference. So to find this 12.5%, I just took 900,000 minus last year's sales, which was 800,000, divided by last year's sales, which was 800,000. And that gave me the percentage change, which worked out to be 0.125, 12.5% right here. So you can see sales increased 12.5%. So all I'm doing in horizontal analysis is just comparing one accounting period to another accounting period to see how things change over time. Now, while the absolute term gives you more information, it tells you exactly how much sales increased by, in this case, $100,000. The percentage term really tells you whether or not the change was material. Okay, and that gets into a concept called materiality. So let's write that down. Materiality.
And materiality is important. And why is the materiality important? Because if the changes are not that big, you really don't have to spend a lot of time worrying about it because you have consistency. However, if the changes are large, well, then you have material changes. In accounting, we're always looking for the material changes. And if you get material changes, obviously those are things you want to address. Right. So always remember about the concept. He's right. This is the best thing we can do here. The concept of materiality is important because if something is big enough and it's material, you absolutely want to pay attention to it.
And materiality refers to the relative importance of information. A lot in accounting. People often say, "Oh,
Hold on a minute. Don't like that little static. Okay, let's keep going.
material difference," or is that change material? And so the only way to figure out materiality is sales is 900,000 or 100% of sales, because sales is sales. Cost of
I want to reset this for a minute, only because I don't like that. I don't like that. The little feedback we're getting. I want to make sure you can hear this.
All right, in this video, I want to introduce the idea of financial statement analysis. And we've spent a lot of time learning how to put financial statements together, how to make income statements and balance sheets and cash flow statements. But we haven't really talked about how users analyze that information, or how they use financial statements to actually make decisions. So that's what we're going to do in this video. And we're going to focus on 3 different financial statement analysis methods. Okay, we got horizontal analysis, we got vertical analysis, and we got ratio analysis. So we're going to kind of introduce each of these briefly in this video. The first one is horizontal analysis. And in horizontal analysis, we're just going to compare across accounting periods. So we're going to do things like compare sales. So we'll compare sales in year 4 to sales in year 3. And we can do it in absolute terms, which means we can compare, well, in year 3 we had 800,000 in sales, and in year 4 we now have 900,000 in sales. So we've had a $100,000 increase. That would be the absolute increase. Or we can look at the percentage increase. And you see here I have the percentage difference. So to find this 12.5%, I just took 900,000 minus last year's sales, which was 800,000, divided by last year's sales, which was 800,000. And that gave me the percentage change, which worked out to be 0.125. 12.5% right here. So you can see sales increased 12.5%. So all I'm doing in horizontal analysis is just comparing one accounting period to another accounting period to see how things change over time. Now,
And that's essentially what horizontal analysis is. you're looking at things. Think about horizon, what the horizon is. Horizon is when you look out into, like, say, when you go to the beach and you look out and you can't see past like the edge of the water. That's the horizon, right? It's flat. It's left to right or right to left. It's horizontal. So what we're doing is we're taking a number of years and we're looking at the changes in a horizontal fashion.
While the absolute term gives you more information, it tells you exactly how much sales increased by, in this case, $100,000. The percentage term really tells you whether or not the change was material. Okay, and that gets into a concept called materiality. So let's write that down. Materiality. And materiality refers to the relative importance of information. And this is a term that's used a lot in accounting. People often say, well, was it a material difference? Or is that change material? And so the only way to figure out materiality is to look at the percentage difference. So we can say, yeah, sales increased by 12.5%. This was a material change. It's important. And usually we say something's material if it would affect a user's decision. So if it's a change that would affect a user's decision, then it's a material change. And you'd probably say, yeah, 12.5% increase in sales is a material change. Okay, so we can also conduct horizontal analysis or trend analysis over several accounting periods. If you look down here, you can see I have sales, but I have it not only for year 4 and year 3, but also have year 2 and year 1. So I have my sales for 4 years. And you can see I'm looking at two percentages. One is the increase over year 1 sales, and one is the increase over preceding year sales. So if we're looking at year 4, you can see year 4 sales are 50% higher than year 1 sales, but they're only 12.5% higher than year 3 sales. So you could do this kind of analysis on any item on the income statement or balance sheet. It's basically just telling you how things are changing over time. All right, but sometimes we don't want to just compare how things are changing over time. We want to compare things within a specific accounting period. And for that, we'll use vertical analysis. So you can see I have a vertical analysis here. This is a vertical analysis of the income statement. And what I'm doing in this table is I'm scaling everything by.
Now, vertical analysis is a little different. We're looking up and down. We're looking up and down. We're looking at one particular year and we're trying to see what that looks like on a vertical basis, up and down.
Sales. So everything, I'm basically taking everything on the income statement and I'm making it a percentage of sales. So you can see sales is 900,000 or 100% of sales because sales is sales. Cost of goods sold is 610,000 or 67.8% of sales. So the way I would get this 67.8, it's just my cost of goods sold, which we said was 610,000.
Remember, when you're doing a vertical analysis, sales becomes 100%. And every other thing, every other item becomes a function of sales. So you could see in a particular year, for instance, cost of goods sold that year was 67.8% of sales. Now, sales actually goes down, but the percentage also goes down as a percentage of sales. So even though the numbers change a bit, we see that the goods cost us more money relative to sales in year 4. And that would definitely start a question for me. It would be like, why did that happen? Why did I lose my margin? Why am I paying more for goods? And there may be a good reason for that. Maybe I'm selling more expensive goods. I'm not sure, but definitely a question I want to ask. Here, operating expenses also went down as a percentage. See, once you use percentages, you can clearly compare no matter what the numbers are. Well, why did that happen? That's actually a good thing. So those are two questions I'm going to look at.
Divided by sales, which was 900,000. And that gives you 0.678 or 67.8%. So I'm dividing every item on the income statement by sales. And so now everything is a percentage of sales. And by doing this, it gives us a lot of information about where our sales dollars are going. And you can see 67% of sales dollars go to pay for our goods, cost of goods sold. 27.6% of sales dollars go to pay operating expenses. And 1.9% of sales dollars go to pay taxes. And so you can see after all the expenses, our profit is only 2.8% of sales. You can also compare vertical analysis numbers across years. So notice that in year 3, my cost of goods sold was only 60% of sales, but in year 4, it's 67.8% of sales. So what does that tell us? That means that the cost of the goods that I'm selling has increased. So if I'm a merchandiser and I'm buying these from some manufacturer, the manufacturer is now charging me more for the goods that I'm selling. And you can see during that same time period, my own operating expenses decreased. In year 3, they were 35% of sales, and in year 4, they were only 27.8% of sales. So this is the kind of information you can derive by conducting a vertical analysis. But it's simply just taking everything on the income statement and dividing it by sales and then comparing the percentages. Okay, we can do the same thing for a balance sheet. You see, I have a balance sheet here. So this is a vertical analysis for a balance sheet, same company. But for the balance sheet, we're going to scale everything by assets. Okay, so everything's going to be a percentage of assets. So you can see year 4, my inventory made up 13.8% of assets. And in year 3, it only made up 9.5% of assets. And the same thing works in the liabilities and stock.
So this really works when you do vertical. They both work. In a horizontal, I can compare other years. In a vertical, I can see for year to year what the percentages of each thing. Now look at that. Inventory costs went up again. Why are these costs going up? You know, that's a question I'm definitely going to ask. Are my suppliers charging me more? Could it be inflation? But if it's inflation, then sales should go up commensurately. Here's another question. If this was inflation, then the sales should go up too because I can raise my prices. So maybe what this is telling me is I don't have pricing power. That could be an issue.
Stockholders' equity section, you can see my total liabilities were 28.7% of assets in year 4, and they were 31.4% of assets in year 3. So my liabilities have decreased, and you can also see the equity has increased. Equity was 68.6% assets in year 3, and now it's 71.3% of assets. So with the vertical analysis on the balance sheet, you're just going to take every item and divide it by total assets. And that will put everything as a percentage of assets, and then comparisons are a lot easier. Whether you're comparing across years or you're comparing different companies, you can do either because the absolute numbers don't matter anymore. Everything's on a percentage basis. All right, and the final type of analysis that we can look at is ratio analysis. And this is something that we're going to spend a lot of time in this chapter looking at. And this is where we use financial statement ratios to assess things like liquidity, solvency, and profitability. Now, to help you understand what liquidity and solvency are, let's look at an accounting equation. Let's say this is assets equal liabilities plus stockholders' equity. And let's break our assets into current assets and long term. And we'll do the same thing with our liabilities. So current liability.
So you want to remember the basic accounting equation. Assets equal liabilities plus equity. So once I know two of them, I can solve for the third. So if I know assets and equity, obviously, if assets are $1 million and equity is 300,000, then my liabilities have to be 700,000.
Liabilities and long term. And stockholders' equity, let's just assume we just have retained earnings. So these are our accounts. And let's say we have $1,000 of current assets, $1,000 of long-term assets, $1,200 of current liabilities, $100 of long-term liabilities, and $700 in retained earnings. So let's just say this represents the company's balance sheet. Well, liquidity is the ability of a company to pay its current obligations. So when we're going to look at liquidity, we're going to do things like assess our current assets and our current liabilities. So you can see in this equation, this company had current assets of 1,000 and current liabilities of 1,200. So it may have a liquidity problem because you can see next year it's going to owe 1,200, but it only has a 1,000 in current assets. So it doesn't have enough current assets to cover its current liabilities. So we would say that this company may have a liquidity.
Yeah, so you always want to be able to you don't want your current liabilities to kind of exceed your current assets because at one point you're gonna run out of room. You're gonna run out of money, and you know that some companies, which are actually not bad companies, like I'm not gonna say Bed Bath and Beyond was the greatest company out there, but Bed and Bath and Beyond was definitely a viable company to some extent. They did offer a service, but they ran out of liquid cash. And once you run out of liquid cash, the problem is your suppliers are going to run away from you, basically, because they're going to be afraid they're not going to get their money. You can't blame them either. If they think you're going to run out of cash and you can't pay your bills, you go bankrupt. All your inventory as a seller gets stuck there.
Problem. We could also look at this equation to assess things like solvency. Solvency is the ability of a company to pay off all of its liabilities. So in this case, you can see the company has total assets of 2,000, total liabilities of 1,300, and total equity of 700. So while this company may have had a liquidity problem, it does not have a solvency problem because it has plenty of assets to cover its liabilities. It's got 2,000 in assets and only 1,300 in liabilities. So
You see,
liquidity is the
there's two different things now. We have short-term cash, which is liquidity, right? You need cash. Think about it. You can have like a $1 million home and your house is worth $1 million. But if you don't have cash in the bank and you have expenses, it's going to be a problem. So you got to make sure the long-term assets are there, but you also got to make sure the cash flow is there. I always say to my students, cash flow is king. You have to keep an eye on your cash flow. So sometimes people go ahead and they buy a second home, or they'll buy a bigger home than they can afford, or they'll buy cars that they can't afford. And the problem with that is, while it all feels good, you don't have enough cash on hand.
ability to pay off your current liabilities. Solvency is the ability to pay off all your liabilities. So we'll look at financial statement ratios that help us assess a company's liquidity and help us assess a company's solvency. We'll also look at ratios that help us assess a company's profitability. And the profitability ratios will help us answer questions like how much earnings are being generated with our assets, like how effectively are we using our assets. So we'll look at lots of financial statement ratios in the upcoming videos, and they'll deal with liquidity, solvency, and profitability.
All right, so hopefully that helps you, right? Hopefully that helps you. And that kind of gives you the sense of, and again, going back to feedback, this is why we designed it this way. We were hoping that this gives you the kind of help where you can learn, and while you're learning, you can watch the videos. And again, if after all of that is up, so just looking at it from my own standpoint as a professor, I feel comfortable with that, but I want you to feel comfortable with it. So, please, what I want you to do is um, if you feel that you need further feedback, then just send me a question. That's what I'm here for. And the other thing I want to talk about is the due dates. I don't put due dates on because I want to give you the ability to work back and forth until the end of this class. Not a long class, it's only 6 weeks. I don't want to cut you off from finishing other work. So I don't know why somebody would need that. You just know that you have to stay on top of every week when you do that work, okay? Just try to do that. So you got revenues less cost of goods sold, which is gross profit. There's your income statement. And again, just like he told you in the video, there's the percentage of each good. So you can go back. Here again, cost of goods sold rose. What's the problem there? Why, on a percentage basis, am I paying more for cost of goods sold? Especially if I'm selling more product. Because if I'm selling more product, then my theory as a business person is I can cut better deals, right? I'm giving my suppliers more business. Why is it getting worse for me? Inflation should, and then someone could say, well, it's inflation. Well, then inflation should be working for me in revenue, right? Or maybe I don't have pricing power. So this becomes issues. Operating expense is not material. It's about the same. So I'm not worried about it. But I can actually trace where the net income is coming from. Okay. So those are trends. That's trend analysis that we want to look at. Okay. Just like he did just like he did in the video. And then ratio analysis again, just to be clear on it, your liquidity ratios are your current ratio, which is how much cash you actually have. But remember, or how much current assets you have, your short-term assets. Remember, current assets also include inventory. And if your inventory is not liquid, like let's say it's perishable goods or clothing, and they really can't turn into cash, you've got to take that out. In which case, that's where your asset test ratio comes in. Okay, and then sometimes we could just go with cash. And I prefer that a lot of times, unless your inventory is like gold or silver or jeweler or cars, brand new cars that you can turn into cash, or your brokerage firm that has stocks that could be sold. I really like the idea of having. You got to look at all three, but I think current cash is your best bet to really make sure you're okay if you're a lender to this company, or you're buying this into this company. And then in terms of receivables, I want to know how much are my receivable sales versus my net receivables, and how often am I turning over those receivables? How often am I turning over? Because if that number starts to go down, that means I'm having trouble collecting my accounts. And the same thing with inventory turnover. How often am I turning over my inventory? And as I said I think I might have said to you guys, when you look at a company like Costco, the magic of Costco is inventory turnover. And that's really what they're about, Costco. What Costco does, remember again, the code word is feedback. What Costco does is that they have just one free item, right? Generally speaking, so that you go in, if you're a Costco shopper, you're going to get one type of tomato sauce or one type of cinnamon, blah, blah, blah. But they turn over their inventory in many cases in 10 to 12 days. But they don't pay for that inventory sometimes up to 90 days. So think it out. If I could turn over inventory every 12 days, right? If I could turn over inventory every 12 days and I don't have to pay it for 90 days, I'm constantly getting all that float, like 78 days. And that's significant money when you think about the size of Costco. Now, the flip side to that is I got to make sure I have enough inventory. If I'm not carrying enough inventory, it's going to cost me money. But Costco has done an amazing job because they only worried about one inventory at a time to make sure they always have enough on sale. on store, in their inventory. Profit margin is your income over sales. You want to make sure that you're consistent with the industry. Your cash return on sales also. It's more about the industry. Some industries have small returns, but they turn over a lot of inventory, like a supermarket. Some industries have very high margins, but they don't turn it over as often. Usually you're in one or the other. So if you think about it, if you're selling Lear jets, you're going to have a big profit on the jet, but you don't sell them every day. If you're selling grocery items, you're selling a lot of them at a low margin. That's because that's a business that everybody is trading in. Just think about economics. And another one is, how often do I turn over my assets? Now that could be tricky because if my assets are old, then that turnover is going to look better for me. But I'm going to have to replace those assets. Because think about it, if I have a low denominator, that's going to look good, but I'm going to have to replace them again. So I want to make sure that my assets are viable. Now, there's something a little more advanced. We call it a Q ratio. But what the Q ratio tells us is what my replacement value of my assets are versus my book value, right? So if my replacement value starts to grow versus my book value, I know I'm at a point where maybe I have to start replacing these assets, right? Because if I have trucks on the road that were worth $1 million and the replacement is $1 million, and now the trucks are only worth 100,000, I got a 10Q ratio. Well, I'm pretty much looking at trucks that are old. So you want to keep an eye on your asset life. You want to keep an eye, if you're analyzing a company, you want to keep an eye on the value of the assets, not just that assets are generating income. I mean, how often you see a store that does well, like a bagel store or some sort of specialty store, but it's getting old and it needs to be updated. And that's an issue, right? You want to see companies that continually improve, like Walmart has done, right? I mean, it's still a big box store, but they've done a lot of good things with their store to make it more viable because they're doing great. Return on common equity is your income over what people have given you. So you want to pay attention to that because that's the money you're working with. That's your worth. And then a very important one that we look at and you should be following in the markets is earnings per share. So earnings per share is how much money did I actually make versus how many shares I have outstanding. And that tells me on a per share basis, I've divided my company up in shares, what each share is worth, what each share the company's worth. And once I know earnings per share, that could lead into a very important metric, which is price earnings. So that's how much people are paying per share. Right now, if you look at the S&P 500, they are paying about $25 for a share. So if I get $1 of earnings and you're paying $25, I'm only getting about a 4% yield on average in the market, the S&P being a broad cross section. Obviously, some stocks, tech stocks are trading much higher. Some stocks like Lockheed Martin and Ford are trading lower. But in the end, the average of the portfolio was 25 times. So if I'm only getting 4% yield because people are reaching for stocks right now, and the government's willing to give me 4.25, 4.5, well, then I may want to consider selling stocks right now. Now, I'm not suggesting that because those numbers can get out of whack, but definitely over time, this is concerning to a lot of people. I mean, if you've been reading the papers, you saw that Warren Buffett is kind of getting it more and more out of stocks into cash, and I'm sure that's the kind of metric he's looking at. I mean, if he can get free money from the government as opposed to taking a risk in the stock market, and the stock market at these prices are only giving me a 4% yield on average, something to think about. And then finally, how much I pay out in dividends is a payout ratio. And that really affects people who rely on dividends, right? Because anybody could really create a dividend. You don't have to have let's say you love a stock, but it doesn't pay a dividend. Let's say you love a stock, doesn't pay a dividend. Well, if you were going to put $100,000 in that stock, you could put 80 in the stock and put the other 20 in an interest-bearing certificate and create your own dividend. And that's finance 101. So just because the company doesn't pay a dividend doesn't mean as an investor you can't create a dividend. And so that's why we don't worry so much about payout ratios, because payout ratio is really what the company decides to do. You can change that by yourself. So the only issue with that might be statutory. In other words, what does that mean? For many years, Apple did not pay a dividend because the investors in Apple said, hey, you guys are doing great. You guys are producing new product. Just keep producing it. Don't give us our cash back. That's why we gave you the money. Well, that was fair. But then the legislatures, the congressmen, senators, local legislators, they were complaining. The reason why they complain is many of the pension funds that exist in the country, the good pension funds for the good policemen, the firemen, nurses, nurses, whoever's involved working for the government or working with pension funds, good, hardworking people, teachers. They weren't getting the benefit of Apple because many pension funds will not allow you to buy a stock that doesn't pay a dividend. They want to see that there's income. So at that point, Apple decided to pay a small dividend, and that's how come you got a dividend. But generally speaking, you can create your own. Finally, your debt to total assets are important. That's how much debt you have over assets. You don't want that to grow so much that debt becomes a burden. So generally speaking, if you got 30% in debt, you're pretty good. 70% equity assets, 30% debt, you're okay. But if it gets start growing more than that, you have a problem, and that's where times interest earned comes in. You want to make sure you can cover your interest expenses, and your cash covers your interest expenses, because that tells us that you have enough free cash flow to cover those expenses. So that's it for today. I mean, I don't have much more to share with you, but I want you to remember, feedback is the key code word this week. I'm moving next week's class to Thursday to give somebody a little more time, whoever needs it. I'm going to, because I have a schedule too. I'm going to, you give me questions as you're going along. After you watch videos, you give me those questions, okay? And you let me know what it is, what you need. And remember, on due dates, I'm leaving them open so you're not stuck, so you can move back and forth. But every week you should be doing your work. And definitely by the end of this class, you have to get your work done. I think that just makes it easier for the student. That's the feedback I've gotten from other classes, okay? All right. Well, I'll see you next Tuesday. No, I'm sorry, next Thursday. Thank you.